All right, let's dive right into this explainer. Today we're unpacking a really fascinating financial paradox with Axogen, where bad news on paper somehow translated to a massive win in the market. We're talking about a company at the absolute forefront of peripheral nerve repair, and their latest earnings report just triggered a wild reaction on Wall Street. Honestly, if you only glanced at the headlines, the stock's jump made absolutely no sense.
So here's the core mystery we're unraveling today. How on earth does a stock rally double digits after reporting a massive financial loss? I mean, usually when a company tells the world they're losing more money than they were last year, investors sprint for the exits, right? But with Axogen, the exact opposite happened. To figure out why, we've got to follow the breadcrumbs hidden deep inside their financial statements.
Picture this, May 3rd, 2026. Axogen's stock absolutely surges by 10.3% in a single day. The market was thrilled, institutional investors were buying it up, and the bullish sentiment was incredibly strong. But here's the kicker. That massive rally happened on the exact same day they announced their Q1 net loss had widened to a whopping $19.6 million. For context, in the same quarter of the previous year, their net loss was just $3.8 million. That's a massive drop on paper. So why did Wall Street completely ignore this plummeting headline number and hit the buy button instead?
Well, the secret is actually hiding deep in the financials. When you strip away the one-time costs, their true adjusted net income was actually a positive $4.1 million. You see, Wall Street wasn't looking at the messy GAAP accounting, the standard regulatory rules. They were looking at the underlying operational reality. Let's break down exactly how they bridge that massive gap.
Section 1. Peeling back those Q1 financials to compare GAAP losses versus the adjusted reality.
To truly understand this business, we need to separate the one-time corporate housekeeping from the actual day-to-day business of selling nerve repair products. Right off the bat, top-line revenue surged an impressive 26.6% year-over-year. They went from $48.6 million in Q1 of 2025 to $61.5 million in Q1 of 2026. This tells us that surgeon adoption and product demand are exceptionally strong. The core business engine is really revving hard.
So how exactly do we get from a nearly $20 million loss back to a profit? Well, you add back a massive $16.8 million one-time loss on the extinguishment of debt. Axogen essentially paid off a huge chunk of debt, taking a one-time accounting hit just to clear their balance sheet. Then you normalize for $6.8 million in non-cash stock-based compensation. Boom. Suddenly, we reveal a highly profitable underlying quarter of $4.1 million.
As management pointed out themselves, these non-cash expenses heavily skewed the perceived operational efficiency. It dragged their operating margin down by 3.5 percentage points. Once analysts factored this out, they saw a fundamentally sound company operating with zero debt obligations and a totally clean slate.
Moving on to Section 2, the FDA biologic milestone and how they're building a formidable regulatory moat. Beyond the financial smoke and mirrors, there's a massive fundamental catalyst driving investor confidence here. Let's define the star of the show. The approval of the Biologics License Application, or BLA, for their flagship product Avance transitions them into a highly protected regulatory tier. Historically, this was just regulated as a human tissue product. Now, the FDA officially classifies it as a biologic. Following that historic December 2025 approval, the fully licensed biologic officially hits the market in early Q2 of 2026. On top of that, expanding treatment use cases are right on the horizon, with a highly anticipated clinical readout expected later in 2026 for their entry into the massive $754 million prostate treatment market. This transition is an absolute game changer. It grants them exclusivity and serious pricing power, making it incredibly difficult for competitors to easily replicate their nerve repair platform. By confirming the product's safety, purity, and potency at the biologic level, Axogen is essentially deepening its competitive moat against much larger medical device rivals.
Which brings us to Section 3, raised guidance for 2026 and management's incredibly bullish outlook.
With the biologic approval in the bag and the debt wiped clean, management is going big. They're projecting top-line growth of over 20%, bringing total expected revenue to roughly $270 million for the year. And crucially, they plan to do this while actually generating positive free cash flow. This is literally the holy grail for a growing medical tech company, expanding aggressively without burning through your cash reserves.
And this translates directly into incredible pricing power. Gross margins have steadily expanded from 71.9% last year to a really impressive 75.2% this quarter. They're projected to remain sky-high, right around that 75% mark through all of 2026. When you transition to a biologic, you really solidify your ability to maintain these premium margins.
Now let's talk about Section 4, institutional backing versus execution risks, as we weigh the current market sentiment.
To be totally impartial, we've got to look at who's actually buying this stuff and the unique risks they face moving forward. A staggering 88% of Axogen's shares are held by institutional investors. That shows massive Wall Street backing. The smart money clearly loves the flawless balance sheet, which currently boasts $103.6 million in cash with zero debt obligations. It provides a huge cushion for their ongoing infrastructure investments.
But, we really have to ask ourselves, does 88% institutional ownership represent ultimate market validation or a dangerous crowded trade risk model? If Axogen stumbles on their commercial rollout, could this heavy concentration lead to a rapid sell-off as institutions rush for the exit all at once? When 88% of your float is held by funds, that institutional loyalty can vanish overnight.
The debate among analysts is pretty clear-cut right now. On the optimistic side, bulls absolutely love the massive revenue surge, the new regulatory moat, and that pristine balance sheet. Conversely, the bears are cautioning that executing a full biologic commercial rollout, shifting logistics, and funding those critical prostate clinical trials is going to keep operating costs uncomfortably high.
Finally, Section 5, weighing the final verdict and looking at the road ahead for Axogen.
So, as we bring all the pieces of this puzzle together, what's the big takeaway from this explainer? Well, while Wall Street analysts universally rate the stock a buy, with a short-term price target hovering around $43.88, the long-term intrinsic value models actually tell a different story. There's a wide disagreement in the community on just how profitable this biologic shift will truly be in the long run. Some models see massive upside, while others see a company that's currently fairly valued given its heavy operating expenses.
Which leaves us with one final question. Do the rewards of FDA-approved exclusivity and 26% revenue growth truly outweigh the heavy operating costs and execution risk of commercializing a new biologic? Are you willing to stomach the heavy execution costs today for the promise of a total monopoly in nerve repair tomorrow? The numbers are there, the FDA approval is there, and the cash is in the bank. Now it all comes down to execution. Thanks for joining me for this explainer, and I'll catch you on the next one.